Yes, my dear student, how are you all? I hope everyone is doing great. I am also absolutely fine. Today in this video, we'll discuss all the new question of descriptive nature which has been given in RTP of May 2025 exam. To inform you, we have already discussed the case study MCQ based question of this RTP in a separate video. The link of that video will be given in the description of this particular video. If you have not listened that, you can listen that particular video from that link. Now coming to the descriptive question in the RTP, in this RTP, they have given 6 new type of questions. When I say new type of question, does not mean they are difficult question. Means the balanced question which are not new is exactly the same type of question is given in either ICI study material or I will say in the past RTP or MTP. So when I am saying new type of question, it means there is some changes in the information given in the question. So that become new type of questions. So when I say new, it does not mean they are difficult question. Out of that 6 new type of question, 4 are very simple. You can understand by your own. But then also because it is new, I will discuss each and every point of that new questions. Out of that 6, 2 are different type of question which must be listened. To inform you, let me first inform you what are the question number which are totally new. So we have question number 11. In that we have IND AS 28, a new type of question but very simple. Question number 12, IND AS 109, which is a different type of question, need to be listened before exam. Question 16, IND AS 21, simple but good question. Question number 18, IND AS 7, once again simple. Question 19, IND AS 24, once again simple. And question 20, IND AS 102, I will say different type of question, even though simple but different type of questions. Got this point? Out of 6, IND AS 109, IND AS 102, from my point of view, these are different type of question which means such type of question has not been given in ICI study material till now. I will say these are the questions from a concept where till now no question have been given in ICI study material. Let us discuss one by one. But before we start a discussion, don't forget to subscribe this channel if you are new to this channel. Do like this video and share this video with all your friends. Can we start a discussion? We'll start a discussion with the first question 11, IND AS 28. Now let us start question number 11, which is IND AS 28. Okay, are you all ready? Let us read. X Limited acquired 10% interest in V Limited for rupees 50,000 on 1st June 2006. The investment in V Limited was accounted for as equity investment not held for the purpose of trading. It is not held for the purpose of trading, for which irrevocable option has been availed for subsequent measurement of financial asset at FBT OCI. Means can I say for this it will measure at a fair value and any gain or loss will be transferred to OCI. X Limited recognized an increase in the fair value of 30,000 in other comprehensive income for the year ended 31st March 2007. Means from this it is understood that at the end of the year the fair value of this investment will become 80,000 and the 30,000 has been transferred to OCI and accumulated in FB OCI reserve. Okay sir. X Limited again acquired an additional 25% interest in B Limited. Means initially they acquired 10%. Now again they acquired 25%, total become 35%. Means can I say it will, by acquiring additional 25%, now they will be able to exercise significant influence over B Limited and therefore B Limited will now become associate and IND AS 28 will be applicable. For rupees 2 lakh, 2 lakh is the cost price on 1st April 2007 and achieved significant influence. It is given. The fair value of V Limited net asset was 2,50,000 on June 2006. So at the means the fair value of V Limited net asset was 2,50,000 at June 2006. June 2006 means when they initially acquired 10%, that time the fair value of net asset was 2,50,000 and had increased to 4 lakh on 1st April 2007, and on the date of additional acquisition of 25% means once the V Limited become associate means the date when the equity method will commence. On that date the fair value of net asset is 4 lakh. So can you say we are concerned about this? The V Limited recorded a profit after dividend of rupees 1 lakh between 1st June 2006 and 1st April 2007. It means what they want to say, what is the profit after dividend from 1st June 2006 and 1st April 2007 is 1 lakh. This information is not relevant, I will say. How should X Limited account for an investment in V Limited on account of piecemeal acquisition when such investment provide X Limited significant influence over V Limited? Past necessary journal entry for the same. Now just try to understand. As can I say, it is multiple acquisition means first they acquire 10%, then they acquire 25%, and by acquiring 25% again they are able to exercise significant influence. So this is multiple acquisition, and Ind AS 28 is totally silent about multiple acquisition. However, if you know about Ind AS 103, we have done step acquisition, and if there is a step acquisition and the parent company get control over subsidiary company of acquire, or I will say in this way, acquirer get control over acquiree on the date of acquisition by multiple acquisition, then in that case Ind AS 103 says that any previously held equity interest will be remeasured on the date of acquisition at fair value, and then we calculate goodwill again bargain purchase on the date of acquisition as per Ind AS 103. This is as per Ind AS 103, but Ind AS 28 is totally silent about multiple acquisition. In multiple acquisition, correct now, to obtain significant influence over associate. So in this case, because Ind AS 28 is silent, so what ICA has done in this solution, they have taken the concept of Ind AS 103 and have given the solution accordingly, from my point of view, whatever solution has been given by ICI is 100% correct. Means even though Ind AS 28 is silent, so of course can I say we can apply the concept of Ind AS 103, whatever we used to apply on step acquisition, same thing has been done. It means, can I say, this previously held equity interest of 10% will be remeasured on the date when the investee become associate at fair value. And can I say, already it is given that on 31st March 2007 it become 30,000 and will take 80,000. The fair value on that date is 80,000. So it means, can I say, we'll calculate, means we need to calculate goodwill or capital reserve on the date when the investee become associate, means on 1st April 2007. So what is the fair value of previously held equity interest? That is 10% is 80,000. Okay, correct. And then we'll add fair value of consideration paid. Consideration paid means the cost price of investment to acquire additional 25%. How much we have paid? 2 lakh. 2 lakh. So total it become 2,80,000. And they have given fair value of INA. How much they have given fair value of INA on the date when the investee become associate? That is given how much? You can see they have given 4 lakh. So we'll take 4 lakh ka. We'll take 4 lakh ka 35%. 4 lakh 35%. How much? It is 1,40,000. 1,40,000. And therefore goodwill is how much? 2,80,000 minus 1,40,000 is equal to how much? 1,40,000 is the goodwill. 1,40,000 is the goodwill. Now they have asked the journal entry. So what journal entry will do? So can you say, first on 31st March 2007, we need to first remeasure this previously held equity interest fair value, and that will be transferred to OCI. So what journal entry will do? Investment account debit to OCI, FB OCI reserve, FB OCI reserve, correct? How much? 30,000. 30,000. Now on the date when the investee become associate on 1/4/2007, can we de-recognize the previously held equity interest? We recognize our investment associate as per equity method, and as per equity method now it will be 2,80,000. Correct now. So we'll say investment in associate including goodwill, because this goodwill will not be recognized, it will be only disclosed. So investment associate as per equity method, it will be 2,80,000. And we'll say to investment in means previously held equity interest, you can say investment in V Limited It is how much? 80,000. And how much consideration paid to bank? That is 2 lakh. And can I say once now, because this investment was previously measured at FBTOCI, now this is what whenever we apply FBTOCI to equity instrument, that will be always without recycling. Therefore, FBOCI's reserve will be closed by transfer to retained earning. Correct. So on this date, we'll pass one more journal entry. We'll say FBOCI reserve account debit to retained earning, and how much will be transferred? 30,000 will be transferred to retained earning. Understood this journal entry? Very simple. Means good type of question. Till now this type of question has not been given ICS study material. Suddenly this type of question will come in exam. You will be confused because no question of this nature has been given ICS study material. Good question, I will say. Chalega, let me explain the solution now. What the solution has been given. Correct? You can see they have given what solution? 1,40,000 is the goodwill. First they have given one para. Let me read the para. While applying equity method, Ind AS 28 requires the investment associate to be initially recognized at cost. However, it does not include any specific guidelines on how to account for the existing investment which is accounted for under Ind AS 109 that subsequently become an associate or joint venture. One may apply the fair value approach by drawing an analogy from Ind AS 103. Then they have given the explanation of Ind AS 103. Then they have calculated goodwill same way, and you can see the same journal entry they have done. Investment account debit to OCI, then investment associate applying equity method, and investment which was previously held equity interest now remeasure 80,000, that will be de-recognized, and the payment is done 2 lakh. Then whatever has been transferred to FBOCI reserve, that will be closed by transfer retained earning. Correct? But normally we don't do it by OCI. Correct? Now whenever we do reclassification, we use the account OCI. But whenever it is without reclassification, we never use the term OCI. We use FBOCI reserve account debit to retain earning. Understood? Simple. Now let us come to the next question. Next question is based on Ind AS 109 financial instrument. To inform you that this question is totally a different type of question. Is based on one concept which is related to floating rate of interest. And I hope you know that ICA has not given any question based on floating rate of interest in ICA study material, neither in previous RTP or MTP. Now directly a question of this nature in RTP from my point of view will affect the preparation of any student. Now just try to understand, at this point of time student is preparing from examination point of view, and a different type of question for which we do not have any question in ICA study material. Of course it may affect their preparation. So I will suggest ICA, means it is my request to ICA that if they want to give this type of question, first they should give this type of question in ICA study material. They should not give this type of question in RTP directly. And that too, I will say this question is totally a bakwas question. Believe me, I will inform you when they have prepared this question. I don't know from where they have taken this question and what they actually want to ask from this question. That I will inform you. But nothing to worry. Once you understand the question, believe me, the solution is very, very easy. The same questions comes in exam. Nothing to worry. I will just inform you what to do from examination point of view. But once again, I will say, suddenly at this type of question, RTP may affect the preparation of any student. Correct? Got this point? So it is my request to ICA that if they want to give this type of question, first they should introduce this type of question in ICA study material with proper explanation. However, if you have done classes from me, you can see I have taken one question, one concept related to, you can see, floating rate of interest, and I do take some examples in a class. But I also know that even though I will teach this concept with some example in class, then also my student from examination point will never practice it, and suddenly if this questions comes in exam, of course they will not be in a position to answer this type of questions. Correct? But nothing to worry. Let me explain this question. Suppose this questions comes in exam, how to handle this type of question in exam. Correct? That I need to inform you. Correct? First, let me explain the question. Let us read. Question number 12. On 1st April 2001, ABC Limited issued a 10-year bond with a par value of 15 lakh. Means the company name is ABC Limited. ABC Limited issued a 10-year bond. Means from ABC Limited point of view, this bond is a financial liability. I hope you have understood. And they have issued at a par with a par value. So nominal value become issue price. So this is the nominal value as well as the proceed received. and an annual fixed coupon rate of 8%, which is consistent with the market rate for the bond with similar characteristics. Now you can see what they have written, and an annual fixed coupon rate. It means, can I say coupon rate means contractual rate of interest fixed. Now when you are reading the first para, it seems that it is a question of fixed rate of interest, not a floating rate of interest. Correct? I don't know what they want to ask from the student. Let me read the entire question first. So it means the contractual rate of interest is 8%, and which is consistent with the market rate. It means market rate of interest is also equal to 8%. Yes, sir. ABC Limited uses secured overnight financing rate as its benchmark interest rate. Now I am coming to this point. First, let me explain the first para. So we have understood that the contractual rate of interest is 8% and it is at market terms. Therefore, market rate of interest is also equal to 8%, and there is no transaction cost. So can you see effective rate of interest will be also equal to 8%? Effective rate of interest will be also equal to 8%. Now because the contract is at market terms, can you say initially this financial liability will recognize at fair value and there is no transaction cost, and fair value will be equal to the transaction price received means proceed received, and therefore initial recognition will be done at fair value and the fair value will be equal to 18 lakh and there is no transaction cost. This point you have understood. First para, I hope you have understood. Correct. Understood. Now let me come to the next point. ABC Limited uses secured overnight financing rate as its benchmark interest rate at the date of inception, means on the date of contract of the bond. SOFR is 5%. Correct. So it means they have given one variable rate of interest, that is SOFR. I don't know whether you know about SOFR or not. SOFR is similar to LIBOR. If you know LIBOR, you know SOFR. SOFR. Now what is the difference between SOFR and LIBOR? That is not my means, that is not, I'm not supposed to explain that. This is a point of AFM. You can discuss this particular point with AFM, but to give you some information about SOFR, SOFR is more secure than LIBOR, and nowadays SOFR is going to replace LIBOR. So SOFR is actually based on current rate of interest and LIBOR is based on estimated rate of interest, and therefore it has more risk, and SOFR become more secured, more transparent, and it has less risk, and therefore nowadays SOFR is going to replace, means nowadays SOFR is replacing what LIBOR. That is the difference. But can I say for FR, we are not supposed to understand the difference between SOFR and LIBOR. You know LIBOR? Do you know SOFR? Means one thing is clear, that can I say in this 8%, 5% is SOFR and 3% is fixed. 3% is fixed, and SOFR will change every year. It means, can you see, it is not a fixed coupon rate of interest, it is a floating rate of interest. So how they have mentioned it is fixed, I am not able to understand the question. Means just try to understand. Initially they have written an annual fixed coupon rate of interest. So what is the use of giving SOFR? What is the use of giving SOFR? That is the point of concern. Correct? Got this point? Yes, sir. Means I am just trying to explain what I have understood from the question. Yes, sir. Yes, sir. Now, at the end of first year, SOFR has decreased to 4.75%. So now it has decreased to 4.75%. It means if 5% become 4.75% and the 3% remains same, so it means now the contractual rate of interest will be 7.75%. 7.75%. Now, of course, the contractual rate of interest will change from 8% to 7.75%. Are you getting what I am saying? Now, they have used the word fixed. One doubt will come, why they have given SOFR. What is the use of SOFR in the question if they have given fixed coupon rate? So, I may understand that they have, this is wrongly written. Means there is some typo mistake. We can understand in that way, or there is no need of SOFR. There is no need of SOFR. Got this point? So if they have given SOFR, we need to understand this only, that contractual rate of interest is the floating rate of interest. Yes, sir. Yes, sir. Now the fair value bond is 15,38,110. I hope you remember that whenever they have given fair value is always calculated by using market rate of interest, and you can see this value is consistent with an interest rate of 7.6%. 7.6%. It means, can you say at year end 1, your contractual rate of interest becomes 7.75%. and now the market rate of interest become 7 point, now it becomes 7.6%, and the fair value based on the market rate of interest is now 15,38,110. How they have calculated, let us understand. Now they have given the remaining cash flow on the bond are 1,20,000 per year for 9 years. Of course, can I say 1 year has been expired, or 10 minus 1, now the remaining tenure is 9 years, and 15 lakh at the end of 9th year. This cash flow discounted at market rate of interest equal to 15,38,110. It means they have calculated present value of this contractual cash outflow, and they have calculated the present value at market rate of interest, and the present value will be equal to fair value at year end 1. So this calculation we have understood. Now once again one doubt will come, sir, how it will be 1,20,000? Just try to understand. If it is a floating rate interest question, then now the contractual rate of interest becomes 7.75%. and from my point of view, now your contractual cash outflow will change. Now the contractual cash outflow will change. Are you getting what I am saying? So now it should be 15 lakh into 7.75%, means from my point of view it should be 1,16,250. Got this point? If it is a question of floating rate of interest. Now one point will come, sir, they have already mentioned fixed. If they already mentioned fixed, so 8% is not going to change. So if 8% is not going to change, so it will remain 1,20,000. Then my question is that why they have given floating rate of interest? Why they have given SOFR? There is no need of SOFR. Means the point is coming ki sir, if it is fixed and you are taking 1,20,000, okay sir, I am okay with you. Then what is the need of SOFR? Why you have given SOFR? That is a point of concern. And when you see the solution, lot of confusion will come ki what is the need of SOFR? What is this concept? From where they have taken this particular point? That is totally doubtful. Are you getting? Yes sir. ABC Limited assume a flat yield curve that all changes in interest rate result from a parallel shift in the yield curve, and the changes in SOFR are the only relevant change in the market condition. Means what they want to say, if SOFR will change, then market rate of interest will change, and that is the only reason why market rate of interest has been changed. Means this point is not at all important. They have already given the market rate of interest, so you can ignore this point. Now they have given following discounting factor may be considered. Discounting rate is 7.75%. Now they have given discounting factor based on 7.75%. Now why they have given 7.75% discounting factor? If it is fixed, then okay. Can I say effective rate of interest is not going to change? Effective rate of interest is not going to change. Means whether we change effective rate of interest, our effective rate of interest initially is 8%, and if we are saying it is fixed, I will say there was no need of SOFR. So why they have given discounting factor for 7.75%? It means कि by mistake they have written fixed. They have calculated contractual cash outflow based on fixed. They want to introduce one question based on floating rate of interest. They have given SOFR. They also don't know how to frame the question. They also don't know how to write solution. What to do? Are you getting what I am saying? Yes, sir. Now let's see what they have given. At the end of 9 years, of course, they have given 51.1 paise. It means this becomes 0.4511, and cumulatively annuity factor has been given 6.312. Correct? Means let us take this contractual cash outflow, because already they have given contractual cash outflow. So from solution point of view, we can't change the question. We do not have a permission to change the question in exam hall. Albeit I say that even though you are conceptually strong, if you feel the question is wrong, you have no right to change the question. So can I say based on this contractual cash outflow, it will be 1,20,000 into 6.312. That is equal to how much? 7,57,440, and 15 lakh multiplied by 0.511 is equal to 7,66,500. Total become how much? 7,57,440. It is become 15,23,940. Understood? Yes, sir. Got this point? So can I say we can calculate the present value of contractual cash outflow based on the rate of interest which is derived from SOFR. Correct? So 7.75% the present value is coming this. Okay, what they have asked. What is the amount transferred to OCI at the end of year 1 when the bonds are measured fair value? Oh my God! Just try to understand, this question is for ABC Limited, and for ABC Limited is a financial liability, and financial liability can be measured only at amortized cost or FBTPL. There is no FBTOCI for financial liability. Means how they can say the transfer the difference to OCI? Have you done any question of financial liability measured at FBTOCI? From where they have created this question? What they want to ask? From holder point of view, suppose the same question is from holder point of view, so from holder point of view it become a financial asset, and financial asset can be measured at amortized cost or FBTPL or FBTOCI. Then of course the gain or loss due to fair value measurement may be transferred to OCI. But for financial liability, we have never done measurement related to measurement as per FBTOCI. What to do? This question is completely wrong. Completely wrong. This, just try to understand what I want to say. If suppose this SOFR rate of interest has been used as an interest rate swap, correct? So it may be used as a derivative instrument for cash flow hedging. If it is a question of cash flow hedging, then of course it may be transferred to OCI, correct now? But they have not given anything about the hedging. It is not a question of hedging. There is no point of hedging here. How can we understand by our own it is a question of hedging? It is not a question of hedging. Means question is completely bakwas. Completely bakwas. Now coming to solution. Now solution is very easy. Means I always say that even though you have not understood the question, the solution, the CA final student have a power to understand any solution. Solution is very easy. Let me first explain you the solution, then I'll come the exact concept about this. Got this point? You can see what they have written. They have written that effective rate of interest is initially 8%. IRR means effective rate of interest. Because the benchmark interest rate SOFR is 5%, the instrument specific component is 3%. That already I have said also. Now the contractual cash flow of the instrument at the end of the period 1,20,000 and 15 lakh they have discounted by using 7.75%, and their answer is coming 15,23,940. Our answer was also same 15,23,940. You can see what was our answer, 15,23,940. Now they have compared this with the fair value. Fair value is already given the question, and they have transferred this difference to OCI. What they have written, the fair value of liability at the end of the period is itna, hence ABC Limited should present 14,170 in the OCI. Why it will be transferred to OCI, Baba? Chalo, theek hai. Let us understand the question solution from ICI point of view. Solution is very easy. Now the same questions comes in exam. You can write down the solution or not. Of course you can write down this solution. Very simple. Means if this question comes for 5 marks, it is a bonus question now. So do this question up to this end. Means if you want to understand concept, I can explain the concept also. Just try to understand. If you want to understand concept, let me explain you. You want to understand a concept? Just try to understand. What happened the first year, year one, you are adding by bank. This is a financial liability account. 15 lakh will come. Then you will recognize interest expense by applying EIR. Of course 8% is the interest EIR. Initially it will be 1,20,000, and initially the contractual rate of interest is also 8%. So this is 1,20,000, and therefore this will be 2 carried down 15 lakh. 15 lakh. Understood? Yes, sir. Now what they want to say, now the remaining contractual cash flow, means the remaining contractual cash flow from their point of view, Y1 to Y2 to Y9, sorry, it's 10 year, no? So Y2 to Y10 is equal to 1,20,000, and at Y10 it is 15 lakh. If you will discount by using 7.75%, then this will come 15,23,940. They are saying this, okay? And the fair value by discounting at 7.60%, it is coming 15,38,000. As per their, this 15,38,110. So this difference is what? Difference is what? 14,170. So this difference 14,170 will be transferred to OCI. My question is that, of course, chalo theek hai, we have understood the question. This difference will be transferred to OCI. Okay, sir, you have taken some concept from heaven and this has been transferred to OCI. But what about this difference? Means the solution has not mentioned anything about 15 lakh and 15 lakh 23,940. What happened to this? Who will inform this? Who will give explanation for this? Means what do you want from students? Students should understand everything by their own. You first say that ICI has given a correspondence course and for the correspondence course no coaching is required. Every student needs to study from ICI study matter, but you have not given the concept in ICI study matter directly. You are giving in RTP without any proper explanation. That too at this point of time only when 20 days are left. What do you think about CA final student? That they are Paramatma? Okay, chalo, leave this topic. Now let me come to the miss from my point of view. Just try to understand. It was actually a question of floating rate of interest. By mistake, they have written fixed coupon rate of interest. I'm just now trying to explain you. The 8% has a component of 5% SOFR, which will change. And if it will change, the contractual rate of interest will change. So initially it was 15 lakh. Just try to understand the concept. 50 lakh. This was 1,20,000. Again, it is 1,20,000. This is 15 lakh. Now, can you say for Y2 to Y10 means for the remaining 9 years, the contractual cash outflow will change because now the contractual rate of interest has been changed. So now it will be 15 lakh into 7.75%. It will be 1,16,250 for how many years? 9 years. And 15 lakh is repayable at the end of 10th year. Means right now it is 9th year. Are you getting? 1 year has been expired now. Yes, sir. Now just try to understand. If you find out a present value of these at 7.75%, that will be equal to 15 lakh. That will be equal to 15 lakh. Understood? It means automatically the amortized cost at 7.75%, which will be new EIR. 7.75% which will be new EIR, because if the contractual rate of interest will change, your effective rate of interest will change. Correct? So now, can you see, you need to find out revised EIR, but the present value of these to find out the same 15 lakh with the means if you want to find out revised EIR, the revised EIR will be equal to 7.75%, which is nothing but the revised contractual rate of interest. Understood? It means, can you say 15 lakh, the amortized cost remains same. There is no difference in the initial amortized cost based on 8% and the amortized cost based on 7.75%. Why? Because your contractual cash outflow will change. Now, if it is a financial liability and suppose they are measuring at FBTPL, then we need to measure at fair value, and fair value is given how much? Fair value is given 15 lakh 38,110, and this difference will be transferred to PL if they are measuring this financial liability at FBTPL, because there is no measurement principle at FBTOCI for financial liability. Got this point? If it is a question for in the books of holder, then they can be what? FBTOCI, and then this difference 15 lakh 38,110 minus 15 lakhs will be transferred to OCI. It is a question for the books of holder, not the books of issuer. Got this point? This is the entire concept from my point of view. So I have given the concept also. I have explained the ICS solution with ICS question also. Now the same questions come. Don't try to apply my concept. Apply whatever the solution has been given and do whatever they want to ask. Got this point? I hope you have understood. My job has been done. I have explained this question from examination point of view. Can we come to the next question? Let us come to the next question. Next question is based on IND AS 21. Simple question. We have done similar type of question in class. Let us do it. P Limited Incorporated India owns 70% interest in foreign entity S Limited. P Limited has an INR as its functional currency, while S Limited has US dollar as its functional currency. P Limited sell the entire investment in S Limited for 3,200,000. Means this is a question of loss of control. Yes, sir. Now we know that whenever there is a loss of control and if there is some OCI component, that OCI component need to be closed as per respective IND AS. Got this point? Means of course it is a question of IND AS 21, so there will be some FCTR, cumulative FCTR, that cumulative FCTR as per IND AS 21 will be reclassified to PL. The following information is provided. Net asset has been given 4,000 as total. Out of that 70% belong to P and 30% belong to NCI. Foreign currency translation reserve gain means FCTR total is 900. Out of that 30% is attributable to NCI and 630 is attributable to parent company. Required, how does the entity account for cumulative translation adjustment on disposal of foreign subsidiary? So of course, we need to pass one journal entry. So what journal entry will do? It was the entire investment was sold at what price? 3,200 and no investment was retained. Kinesis will de-recognize NCI. So NCI will de-recognize that carrying amount and the carrying amount will be 1,200 only. Correct. Now 1,200 will be inclusive of 270. Will be inclusive of 270. So 1,200. Correct. And can you say FCTR to the extent of parent company share will be also closed by transfer to PL. Got this point? So this will be 630 to INA how much? Identifiable net asset is given how much? 4,000. They have not given goodwill. We will assume the goodwill is included in this 4,000. Okay, sir? Yes, sir. And to gain, this gain will be transferred to PL. Gain how much? Let us see 3,200 plus 1,200 plus 630 minus 4,000. So gain is 1,030 and this gain will be transferred to profit and loss account. So there are two component gain. One is this FCTR. So out of this 1,030, 630 is FCTR component that will be also transferred to profit and loss account. Simple. Okay, sir. Now let us come to the next question. Next question is based on IND AS 7. Okay. Now what is given? The opening balance sheet means question number 18 we are doing. The opening balance sheet as at 1st April 2006 of an Indian company which account for its transaction in INR, which consists of cash of rupees 1 lakh and share capital of rupees 1 lakh. So opening cash and cash equivalent given rupees 1 lakh. The company borrowed a long-term loan as on 30th September 2006 for US dollar 2,200 when the rate of exchange is $1 is equal to 87. So how much foreign currency borrowing proceed has been received? You can see 2,200 into 87. It is 1,91,400. Correct? Now, there is no other transaction during the year. The exchange rate as on balance sheet date as on 31st March 2007 is 85. So you can see the exchange rate from 87 it become 85. So as per IND AS 21, any foreign currency monetary items need to be recorded at closing exchange rate. So of course, there will be some exchange gain. Exchange gain will be transferred to profit and loss account. What is the exchange gain? 2,200 into 2, that is 4,400 become the exchange gain. The summarized balance sheet has been given. You can see cash will be 1 lakh opening balance. Then how much foreign currency borrowing amount has been received? That is 1,91,400. So this become cash and cash equivalent. Closing cash and cash equivalent. Then share capital remains same 1 lakh. Correct. Other equity retained earning, only there is one transaction, that is exchange gain, that will be transferred to PL. From PL it will be transferred retained earning to 4,400. And long term loan will come at closing exchange rate. The closing exchange rate will be 2,200 into 87, that is equal to 2,200 into 85, that is equal to 1,87,000. Balance it will tally. Okay, sir. How the foreign exchange difference arising from unsettled transaction will reflect in the statement of cash flow? Very simple. Can you see in these, when you prepare profit and loss account, in profit and loss account only one item will be transferred, that is exchange gain, means the profit before tax will be 4,400. Got this point? Correct. It means how to present cash flow statement. Let me explain you. So if this is the cash flow statement, first you write down cash flow from operating activities. There will be only one item, profit before tax will be 4,400, and this is nothing but exchange gain. So exchange gain will be eliminated, means it will be considered as an adjustment, and we'll do minus what? Any exchange gain, because it is unrealized. It is unrealized, so unrealized exchange gain will be eliminated and it will be 4,400 minus. So cash flow from operating activity will be nil. Then cash flow from investing activity will be also nil, and the cash flow from financing activities, how much was the amount? 2,200 into 87. So what was the amount? 2,200 into 87, that is 1,91,400. Got this point? So can you say this become the net changes in the net increase in cash and cash equivalent. What is net increase in cash and cash equivalent during the year is 1,91,400. We'll add opening cash and cash equivalent, and this will become 2,91,400. That will become closing cash and cash equivalent, and that will tally with the balance sheet closing balance. This is the cash flow statement. Very easy. Let's see what the solution has been given. The same solution has been given. You can just see 4,400. First, they have given explanation about that exchange gain that you can read by your own, and you can see the similar type of cash flow statement they have drawn. Okay, sir. Very easy. Similar type of question we have done in the class. Okay, sir. Now come to the next question. Next question is very simple. It is related to IND AS 24. Question number 19. Okay, sir. Mr. Y father own 100% of shares of in A Limited. Mr. Y and Mrs. Y own 100% shares in B Limited. Means the father of Mr. Y control A Limited, and Mr. Y together with Mrs. Y control B Limited. Miss Jad, who is Mrs. Y's sister, provide bookkeeping services from time to time to B Limited. However, Miss Jad is not an employee of B Limited. So she is not an employee of B Limited, but providing bookkeeping services to B Limited. A Limited has increased its loan from 1,20,000 to B Limited to rupees 2 lakh during the year, for which A Limited charges a below market rate of interest. So it is a concessional loan given by A Limited to B Limited. Okay, sir. Required. State whether Mr. Y's father and Mrs. Y's sister are related party to B Limited. Understood, they are related party because can I say both are close family member of Mr. Y and Mrs. Y. So of course they will be related party to B Limited. That is understood point. But if you want to see the diagram is what? Father of Mr. Y control A Limited, Mr. Y and Mrs. Y control B Limited, and the sister of Mrs. Y, that is Miss Jad, provide bookkeeping services of to B Limited. So can I say Mrs. Y is related to B Limited? So the close family member of Mrs. Y will be also related to B Limited, and therefore Mrs. Jad is related to B Limited. Correct? Now can I say Mr. Y and the close family member of Mr. Y, that is father of Mr. Y, will be also related to B Limited. And if you can see, the close family member of Mr. Y is controlling A Limited, and Mr. Y control B Limited. So understood, A Limited and B Limited are also related to each other. Got this point? To A Limited and B Limited are also related to each other. Got this point? The first point is very much clear. Yes, sir. Then what disclosure is to be made in the financial statement of both A Limited and B Limited with respect to the loan given by A Limited to B Limited? Understood, we have already explained right now that A Limited and B Limited are related to each other. Therefore, the related party transaction means whatever loan has been given by A Limited to B Limited, a concessional loan that require disclosure. The amount of the transaction is disclosed, related party relationship need to be disclosed, and the nature of the transaction need to disclose with the outstanding amount. What is the outstanding amount? That need to be also disclosed. If any provision has been created for that outstanding amount, that need to be also disclosed as per IND AS 24. Got this point? Then whether B Limited is required to disclose the dealing with the sister of Mrs. Y in his financial statement? Yes, of course, because she become Mrs. Jad, means the sister of Mrs. Y is a close family member of Mrs. Y, so that is related to B Limited. So the bookkeeping service, whatever transaction has been done, that is also a related party transaction. The amount of that transaction and any outstanding amount need to be also disclosed. Got this point? Yes, sir. Simple question, but I have explained this question also in IND AS 24. Understood? Yes, sir. Now let us come to the last question which require discussion, that is IND AS 102, share-based payment. Can we start a discussion? Yes, sir. Good question. It is a different type of question and good question also. This question is related to this question is actually based on share-based payment with cash alternative, but the option is not with the employee, the option is with the entity. Now there is no such question is given ICS 30 matter where the option is with the entity. So this become totally new question. However, the solution is very easy, but I will say there is no such question. There is no such question based on that concept in ICS 30 matter. So this become a totally a new question. Got this point? Yes, sir. Come to the question. Question number 20. As at 1st April 2001, entity enter into a share-based payment arrangement with this employee. The terms of award are as follow. Employer is required to work for his entity for 5 years. So 5 years become the vesting period. After that, they will receive a cash payment equal to the value of entity share. So from the first para, it is we are getting an information that it can be a cash settled share-based payment transaction where the payment will be done based on the fair value of equity shares. Okay, sir. If the entity achieves a successful IPO during the 5-year period, the employee will receive free shares rather than cash payment. So if entity achieves a successful IPO, then entity will not pay in cash. Entity will give free shares rather than cash. Means right now we don't know. It is based on what? It is based on the achievement of that target is what? Successful IPO. And here the option has not been given to the employee. It is based on the some expectation, the expectation of entity. So can it become SBP plan with cash alternative where the option is with entity, correct? Now whether to give cash or whether to give shares, that is with what entity. Got this point? Yes sir. So the employee might receive free shares at the time of IPO or cash payment at the end of 5th year, but not both. But not both. No employee expected to leave the entity over the next 5 years. Means what is the total number of employees that remains same over the vesting period. At the date of the award and till the end of second year, it was not probable that successful IPO would occur before year 5. Now what our Ind AS 102 says that if there is an SBP plan with cash alternative and an option with entity, then we need to find out whether it is, means we need to find out what is the probability of cash settlement. Means if it is probable that entity will go for cash settlement, then the entire transaction will be accounted as cash settled share based payment transaction. But if there is no probability, means if there is no probability of cash settlement, then the entire transaction will be accounted as equity settled SBP transaction. This is very simple. So okay, first year, second year, there is no means I will say there is a probability of cash settlement. Therefore initially it will be accounted as cash settles SBP transaction. We to recognize one SBP liability. We to recognize SBP liability for which the vesting period will be 5 years. Yes sir. At the end of year 3, a successful IPO become probable. Now it become probable that IPO will achieve. So if IPO will be achieved, now there is no probability of cash settlement. Therefore, can I say we need to reclassify SBP liability into SBP reserve. Now when you are doing reclassification, the SBP reserve will be accounted as fair value based on grant date. Fair value based on grant date. Got this point? And the management expect it to occur in 4 years, and the expectation is that IPO will be achieved in 4 years. It means now the vesting period will be 4 years, not 5 years. At the end of 4 years, a successful IPO occur and employee receive free shares. And actually, the IPO achieved at the end of 4th year. The fair value of equity settled award alternative is 1000 on grant date. So fair value of equity settled award is what? 1000 on grant date. The fair value of cash settled alternative, ignoring the probability that an IPO will happen within the 5 years, is as follows: 50 at the end of first year, 500 at the end of second year, 100 at the end of third year, 50 at the end of fourth year. How the entity would account for this transaction? Very simple. So can I say for the first year, because they have not given the number of employee, they have not given the number of option per employee, so you need to assume there is only one employee with only one option, and you do accounting treatment based on that assumption. Got this point? So in year 1, what is the fair value of cash settled award? It is 50. So 50 divided by 5, so we recognize an expense of 10. So first you will recognize an expense of 10. Our general entry will what? EB expense account debit to SBP liability. Then year in 2, again it will be a cash settled award only. We to do accounting based on cash settled award only. So here it will become 500. So we will do 500 2 by 5. So 2 by 5 means it become how much? 200. Out of that, how much we have recognized as an expense? 10. We will recognize how much expense for the second year? 190. The general entry will be EB expense account debit to SBP liability for the second year. Got this point? Yes sir. But in year 3, now we require reclassification of SBP liability to SBP reserve based on the fair value option on grant date. So now it will be 1000, but our expected vesting period is now 4 years. So we'll do divide by 4. So it become how much? 750. Out of that, how much is already recognized as an expense? 200. It means now our expense will be how much? The expense will be 550. Our expense will be 550. So first we'll do reclassification of SBP liability to SBP reserve. So already we have recognized an SBP liability 200. We'll do SBP liability to SBP reserve 200, and then we'll again recognize an expense of how much? 550. Our general entry will be EB expense account debit to SBP reserve 550. So now the SBP reserve carrying amount will become 750. And at the end of 4th year, we'll do 1000 minus how much already recognized? 750. We recognize an expense of 250 again. So our last journal entry means at the end of 4th year, our journal entry will be what? EB expense account debit to SBB reserve with an amount equal to 250. Now SBB reserve total will become 1000, and of course now the free shares will be given. The journal entry will be SBB reserve account debit to equity share capital, because the nominal value of the equity share has not been given, so you can say to equity share capital plus securities premium rupees 1000. Got this point? Let's see the answer what is given. I hope you have understood the entire explanation what is given. You can see first EB expense account debit to SBB liability with 10 rupees. Then second year EB expense account debit to SBB liability with 190, that is 200 minus 10. Then at the end of third year, first the reclassification has been done, SBB liability to SBB reserve 200, and they have recognized another expense of 550, means we have done 750. Out of that 200 was already recognized, so 550 will become an expense and it will be accumulated in SBB reserve account. Then at the year end for once again 250 expense will be recognized, and then we'll do the journal entry for the allotment of equity shares, that is SBB reserve account debit to equity share capital, plus also you can add on securities premium because they have not given the nominal value of shares with rupees 1000. This is the entire discussion of RTP. All the new type of question we have discussed, each and every point I have explained. I hope you have liked the entire explanation and you have understood each and every point. I will say that do this IND AS 102. IND AS 102 is a good question. That IND AS 109 already I said bakwas question, but the same question if they ask, you should be able to do it. That IND AS 28 wala, IND AS 28, the question is also very good question. Till now that type of question has not been given in ICS study material, so that question can be asked in multiple choice question also. So from my point of view, that question is also good. I hope you have understood, you have liked the video, and if you have liked the video, press the like button and do share this video with all your friends. Bye bye, all the best. In the next video will come with MTP, some new model test paper of May 2025, that also will come as a separate video. I think in that only one question new, that one question I will discuss in the separate video. Got this fine? Love you all. Bye bye. Take care.